Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Welcome to episode 3 in this mini-series. And this is all about the full application to mortgage offer and what really happens behind the scenes. There's a common belief that once you submit the full mortgage application, it's just a waiting game. Forms go in and an offer comes out. But in reality, this is one of the most active, risk-sensitive stages of the entire journey. Underwriters are analysing you, valuers are assessing the property, and documents are being scrutinised. Small issues can delay or derail the deal. In this episode, we're going to break down exactly what happens from the moment your application is submitted, how lenders assess you and the property, what can slow things down, and how to keep control of the process until that mortgage offer is issued. So let's get into it. Welcome back, Mark. And this is episode 3 in the mini-series and a really important part of the series. And this is probably the one that we are most highly involved with out of all of the sections. So a really important one for us to cover and to kind of try and share a little bit more of the journey and how different stages of the journey are important and what to consider at each stage. So this is all about from getting the full application submitted. So you've gone through stage 1, which is, doing your due diligence on a property and understanding what that looks like and ticking a lot of those boxes and getting your paperwork in line, then becoming finance ready, getting all of your own documents in place and making sure, getting to the point where you're ready to make an offer or possibly made an offer. And this is the point now in the journey where, the offer's been accepted and now you want to submit your full mortgage application and really start the finance journey. So, as with the other episodes, we have a number of steps that we're going to go through. And in this one, there's 9. And I'll just kick them off if that's okay with you.
Yeah, let's go for it.
So step 1, submission of the full mortgage application. What are the next steps and what is the role of the full mortgage application?
Yeah, so as you say, this is the bit then when we truly do get even more involved. So we're picking this conversation up on the assumption we've already identified which lender we're going to go to. So that was part of the being finance ready. We've done some pre-work under that conversation, established perhaps a short list of lenders, maybe not the exact one at this juncture. So we'll go through that conversation with the client. Then we're going to settle on a particular lender, and then that's when we actually obviously start the application process. Assuming that you've gotten yourself ready and in a good position in the first instance, this should be a relatively painless thing. It's something that we will do behind the scenes. We have access to multiple lenders and their application systems. So we log in and we obviously key the data. So we transpose the information from what we've captured across to the lenders thing. A couple of considerations really around the application process is as more lenders adopt better technology, some of these processes are automated. So there will be automated credit checks going on in the background. So we're only as good as the information we're provided with. So therefore, if it's not unheard of that they will do a check and find something that we just weren't aware of, and sometimes the client isn't aware of, to be fair, on the back of that. And just to explain how that can possibly happen is there isn't just one central credit reference agency, there are multiple ones. So you've got Experian, Credit Union, 2, there's a third that escapes me at the moment. Equifax, that's it. And surprisingly, something can appear on Experian but not appear on Equifax. And certain lenders use different credit searches. I'm getting into a bit of a technical side here, but sometimes things can go unnoticed on credit reports with one lender and then appear on a different lender. And some people wonder why. And that's the reason why that would happen. So that's something to bear in mind. And so we'll key that in, get that across to the lender. The process and the information that we ask for from you. So we try and gather as enough information at the front end. We don't want it to be labor intense when you're coming through the process, because let's face it, you may not actually have your offer accepted and you may not apply and all those good things. And then we will just go through the process, and if there's additional bits of information needed, we'll come to you to let you know exactly what those are. They could be, some lenders are very detailed in the property information that they capture, whereas some just semi-skirt over it. They just want to know how many stories are in it and how many bedrooms. Others do go into real detail as to what is needed, and sometimes we need to come back over stuff like that. But yeah, on the whole, if you've gotten yourself finance ready, as in the previous episode, it's probably give us the baton, if you like, and we'll just get on with it in the background and just come to you for any gaps.
Yeah, awesome. So in the first instance, you submit the application to the lender, and this is where maybe if a decision in principle has already been done, maybe some lenders have slightly different processes, but they might have done a soft credit search at decision in principle stage. And then when it gets to full application, they may do a hard credit search, and that can sometimes throw up some differences. Application goes in, they'll automate potentially some initial checks, or they will have a pre-described information that we would require, like a signed direct debit mandate and a bank statements or ID, whatever it may be. The underwriter gets assigned to the case, and generally as well, the valuation will be instructed at that point. So there'll be fees, usually if there's a valuation, and sometimes a booking fee or an application fee with a lender. All of those fees are paid, application goes in, and that's the point then. So the journey now has really begun. But whilst you get a decision, excuse me, can't get my words out. A decision in principle is an agreement in principle, whilst that's a soft yes. Once the application goes in, we get a more of a harder yes based on the information provided, but then there are also it's a yes subject to underwriting and valuation, and then further down the line, the legals. So at this stage, the deal isn't approved, whilst it's been accepted as a full mortgage application and not declined at that point. It's just the next step in the triage of the deal, and now it's being investigated fully. So we move on to step 2. Was there something you wanted to add?
Yeah, so just want to go back on the valuation point is, in most instances, the valuation is instructed at once you submit. Lenders are getting better to speed the process up, because that can be a bit of a lag as well. However, there are instances where if we know there's some nuances or there's potential some challenges with this, and we want the underwriter to review it first before incurring the cost of potential evaluation, and then that comes back all good and they want to underwrite you as the borrower, we can delay that process. So we can control that piece of the application process. So don't be nervous about that. We can, if we think there's an issue, we'll often recommend, look, let's hold off the valuation, get that point signed off, get the underwriter to say yes, then we can go back and instruct the valuation.
Yeah, awesome. And sometimes people will take, if speed is an issue, they will instruct the valuation knowing that there's a risk that there might be something else, and they may go, well, I'll take the risk because I have to from a speed perspective. But that's a conversation we'd always have up front. So once the application goes in, we'll move on to next step 2 then. So for our listeners and clients to understand the role of the underwriter within the process. And this is where we pass the baton effectively now, if we're going to put a relay into it, is passing the baton over to the underwriter and letting them now do their job. We've submitted the application, which will have all the information, the property details, your details, the product you want. They will then, and we've submitted the documents, and their role then is to, on behalf of the lender, sense check it and make sure, they're checking for fraud, they're checking for lots of other information. But in the main, they are making sure that everything adds up. So they'll be looking for evidence of your income, your ID. They'll have their own anti-money laundering requirements that they'll need to go through. And then, so that's just matching documents and information. And then there's the actual underwriting of it, which is, does this make sense? Does it fit our criteria internally? And is there anything that doesn't make sense about this case? Is there anything that jumps out that they need to ask more questions? And that will start uncovering things. So are there any key roles of an underwriter you think that's probably best to discuss?
Yeah, so I think what this does remove somewhat is this computer says no. That everybody seems to think, computer says no answers. And like you do get some of that with the vanilla lenders, absolutely. You know, they've got some very tight criteria. If you don't meet it, there's little you can do about it. But there are generally people in a process underwriting these cases. Their job is to identify the risk that exists in a deal, really. So you've gone through point A, which is that decision in principle. Point B is the agreement in principle. So there's been more information put onto the application that's been tested. Now it's, as you say, given to a human to have a look at that. So, you know, based on the people that are behind this deal, does it make sense? As you say, is there any anomalies in the information that we've got that need to be cross-referenced or checked? We come back to that source of wealth, the source of deposit with that as well. Now, that's that's 100% always a person that's looking into that because we end up speaking to them so frequently about it. Also understanding there can be terminology in this space, in the sector, can vary widely, and people's understanding of different terminology. So intercompany loans versus commercial loans versus directors' loans, and people's understanding of that needs to be tested. So you have to bring a human in because it can be keyed in innocently enough by a broker saying it's an intercompany loan, whereas actually it's a director's loan because they've misunderstood the terminology and so on and so forth. So that's just an example of where, you know, jargon can get in the way of what's actually going on, and the underwriter will usually pick that up and go, hang on, that doesn't quite make sense, what's going on here, and we'll ask for supporting information. The other thing as well is if something doesn't tick the criteria box automatically, this is where it's good. You can actually speak to the underwriter, justification, what's the risk mitigant if there is something that stands outside of the normal criteria. And they will take a view on these things as well. So are they comfortable with the level of risk, and have they got the authority to sign that off? So all in all, I would say it's a good process. The more specialist the lender, the more leeway they have, I guess, to make more specialist decisions. But then you're going to pay for the higher interest rates on that as well, because that comes with a different level of risk, as you can imagine. So if you're going on the vanilla stuff, don't expect to have that ability to be able to negotiate on it. If you go into your more specialist lenders, then that's exactly what they're there for. And we have very strong relationships with underwriters at that stage.
Yeah, and on that note, one, they're more expensive generally in rate, the specialist lenders, because they're prepared to take a little bit more risk. And two, because it's more of a manual process where underwriters are taking their time to understand those risks, that comes at a cost, doesn't it? It's not as quick. So one, the rate needs to cover the cost of the underwriters, and two, the speed of which you can get those deals over the line are a lot slower compared to your more vanilla lenders, like you say, where it is a lot more computerized and automated for the straightforward deals that can fly through the system. So yeah, that's a really good point. And like you said, you know, they'll be running the background stress testing of the portfolios. They'll be looking at the rental stress tests to make sure that those make sense and those will, you know, be affordable, and that will be backed up with the valuation that we'll talk about shortly. But ultimately, the underwriter's job is longer term is to approve your deal, but in the short term is to identify, at the point of application, is to identify what risks does the bank face in lending you the money. So step 3, which is where we talk about the valuation process. So whilst the underwriter is going through your documents, assessing you as an individual and as a potential borrower and your ability to repay the loan, the valuer has been instructed, they've gone out, they've inspected the property, and now they've got their own checks as an independent person that's been obviously instructed by the bank to come back with a valuation. Now, we will have submitted a valuation based on what the client has told us at the point of application. It's not our job. You know, people come to us on a purchase. The purchase price is the purchase price generally, but on a remortgage, it is slightly different. But for the purpose of this, we are talking about purchase price on a purchase. So they will just come in. The valuer will come in and say, right, you're buying this property for 250,000. You know, and then they will agree whether that is the market value. And if it is a suitable price to pay for the property, they will then put a rental valuation on the open market rent. They'll comment on the condition of the property, albeit it's not a structural survey or a home buyer's report. It is just a valuation, but they will comment on the condition if there's anything glaringly obvious to them. And they will also, which is one of the most important things they'll do, is comment, whilst the rent, they'll put a figure on the rental value, they'll also comment on the demand for that type of rental property in that area, which is a pretty important thing that we talked about in episode 1 of this. And then finally, they'll collate some comparable evidence to back up the valuation that they have come up with. They won't pull a figure out of thin air. And so once the valuer has done their report, they will report that back to the lender. Now, in some instances, you'll get a copy, or in most instances, you'll get a copy of that valuation report, but not always. And this is something that can cause a bit of friction, especially when things get downvalued, is that you might have paid for a valuation report, but you're paying for that valuation report on behalf of the lender, not for yourself in some instances, and this isn't in all instances. The valuer will then report that back to the lender, and then the lender will then look at that report and assess it against the application, and how does that filter into the whole application, and you're assessing the overall deal. The important thing there then is, does the valuation match the purchase price? Does it match the projected rent? And is the property type acceptable as a security for that lender? And that's where it can then sort of affect lending. Is there anything on those sides, on the valuation there, that I haven't covered that you think is important?
So I think the thing, and we've done episodes on this, and we've gone into this in real detail. So check out previous episodes on that. So I'm reluctant to sort of go over ground that we've covered in previous episodes. Very often it's ultimately the instruction that goes from the lender to the valuer. So this is why we can have different opinions in values, because we don't know the question that's been asked, and you can ask the same valuer can go out and value the property for 2 different lenders and come up with different values because the questions have been different. So that's something to bear in mind. Yeah, the valuation is actually not yours, it's the lender's. So you are paying for the lender to have their valuation, because you're making a presentation to the lender with your application that this is suitable security. That's what you're trying to prove. This is suitable security, and I am credit worthy for you to lend me the money based on the criteria that is out there. And it's one big presentation. So you are paying to present the valuation report to them. And as you say, it can be an area of friction. Most lenders do ultimately give you a copy of it. There's one lender in particular that won't show you anything in regards to the valuation report, which is quite difficult if it doesn't come out where you want it to be, because you just don't know what the problem is. And we do have issues where the valuation doesn't, it's not that necessarily that it won't support based on the value, there's a problem with the property that was unknown. And that problem may just be a problem for that particular lender, not a different lender. The beauty of it is we now know exactly everything about that property because it's been valued. And then the second attempt, then if we have to go to a different lender, is more likely than not successful, because we now understand if there's a quirk, we address that before going to the next lender. So not all is lost. And you can also do something called a retype. In some instances, some lenders will allow you to reuse that valuation with the consent of the lender, of the original lender and the valuer, to save yourself some money as well. So there's a lot that goes on to that valuation. As I say, we've done this in significant detail in previous episodes. So I won't dwell on that too much other than what's been covered.
It's probably a point to note here that I did mention that this is a valuation for mortgage purposes and not a survey. And those are 2 very different things. I've also done a podcast recently with Richard, who used to work for eServe and is now providing a home buyer service. And so if you are looking for more of a structural survey or a home buyer report on a property to really understand the fabric of the building, then I suggest that it's probably good. You might want to have done that before you submit the full mortgage application if you've got any concerns. But that would be a good point at this juncture to have that done as well as the valuation.
Yeah, I agree.
So then on to step 4 then, which is the rental assessment and stress testing. So for buy-to-let loans specifically, obviously lenders calculate the interest cover ratio, the ICR, which we talked about in the last episode. Then they will apply the stress test to that, as Mark mentioned in the previous episode as well. All of this will be based on your tax status, whether you're a person buying in a personal name or a company name, and if it's personal, whether you're a lower rate or higher rate taxpayer. And they will also look at your portfolio concentration, so your background portfolio. So all of those feed into that rental assessment. And then ultimately, the lender needs to go through it and just verify all the numbers. All being well, then it'll fly through, happy days. If it's not the end of the world if the rental assessment comes back lower, so let's, for argument's sake, say that the rental, you put on the rental income, there was going to be £1,000, and actually the valuer says it's £900. The underwriter will now apply £900 to the stress test, which means the loan it may still already fit, but what it might mean is now it doesn't meet the affordability rental assessment, in which case they will still lend to you, but they will just reduce the borrowing which they will lend to you, in which case your loan might not be at 75%, it might be at 73%. And that's just something that would need to be considered based on the loan amount that you're asking for.
Yeah, definitely. And one of the things to consider here, and this is a kind of a pushback we sometimes get, is you got two different rental figures. You got a market rent and a passing rent. Passing rent is the rent that it's actually currently achieving. So if you're buying a property with a tenant in already and it's fully let, then there's a passing rent figure. Most lenders invariably lend on the market rent. So that's the rent they could achieve in the open market if they were to put it back out there or have to recover the property. So just bear that in mind. Some of the pushback we've had in the past is where the valuers come back with a market rent and the market rent is lower than what's currently being achieved. Now, that is deemed to be over-rented. So the market would command a rate of, let's say, £700, but you're achieving 800. You've worked the numbers on 800 because that's what the rental income is on the purchase, etc. And that's why the difference would exist. So the lender's only interested in really, because this is a piece of security, don't forget. This is what they're going to rely on in the event that you would default on the mortgage. So they're obviously going to only take the market rent, not what you happen to have. Because if this tenant leaves, this property only should be commanding what the market rent is. So we do have some pushback on that, but that's the rationale behind it. So don't be surprised if it comes back. And as you say, that formula then is just such that they will reduce the loan offer. And it's up to you if you want to decide to purchase it, you just make up the difference, or you walk away or renegotiate even.
And there will be some lenders that will accept the passing rent, but the majority will go off market rent. So it's not to say that they can't be done. It's just that, again, we're trying to cover all areas so that the general consensus will be market rent over passing rent if it's lower.
Yeah, and there is an argument if you can push these envelopes. We do this on HMOs, commercial valuations, and these sorts of things to try and capitalize or maximize the output of stuff. But then the argument is if you do lose that tenant who's paying £700 or £800, £100 more than in the monthly rent is £1,200 a month more, and then you can only market it for the actual market rent, then you've put yourself in a position where you're perhaps stressing your own income a bit more than you need to be doing. So again, these metrics here are sensible metrics. They're not here to catch you out. Just trying to be sensible and realistic about what the property can actually deliver.
Yeah, definitely. So let's move on from valuations, because I think we could end up down the rabbit hole again. So section 5 then would be queries and conditions. So, and this again, this is where we start probably getting, depending on how many queries and questions we get, is clients they become a bit frustrated at this stage, especially if underwriter, sometimes you remember an underwriter is a person like you and I, but ultimately they've just got a job to do, and it's not them singling you out. But sometimes you can get people on a bad day, or they've picked something up with a case and they just haven't liked it. They've had a bad feeling in their stomach at the beginning, and then you've got to really work hard and win them around. And sometimes on a different day, if they picked that up, it might have gone through a little bit easier, and vice versa. So you have to bear that in mind, and that just needs to sit in the background at all times when you're talking about these things. But they may have seen something on a bank statement that they didn't like. Time may have gone on, so they might need an updated bank statement or an updated pay slip. They might need an explanation on a credit blip that you may have, which you've come back to them and they're not satisfied with the answer, so they've asked you for further clarity or further evidence. They might ask for copies of the tenancy agreements. You may have changed letting agent, and now the previous letting agent has the original tenancy agreement and you can't get their hands on it. You might need a letter from your accountant. Your accountant might be on holiday or it might be in the middle of tax season, so it's slow to get a response off them. So all of these things can cause delays, and then it takes time to get them, and then they might have another query, and there's a lot of back and forth, and there's pressure coming from the buyer, from the seller and the agents possibly. You're feeling that pressure. You're trying to, and so this is where the frustration kicks in, and this is when everyone needs to work together for the right outcome and the quickest outcome possible. So, a query isn't a problem. It's just part of the process, and it's just getting the lender comfortable enough to get you to the point where they can offer you the mortgage.
Yeah, couldn't agree more. And so one of the things, a tip that I would give to anybody who's going through this process, whether it's with us, with a different broker, or you're doing it yourself for that matter, sometimes what happens is the underwriter will send us either through an email or through a notification on the application or what have you, and they will just ask for information or they will ask a question. And all too often we can just answer the question. Now, that is fine. And obviously that sounds obvious, that just answer the question. However, what we need to try and do, and what we try and do as often as possible, is understand, what are they trying to evidence? There's clearly a risk. As I say, they're there to evidence and mitigate risk. What are they trying to satisfy as a result of that question? We've been caught in this, death loop of just sending answers back and then getting another question and another answer, and then just picking up the phone and going, right, what are we trying to get here? Actually, can I just send you this document instead? Because that will show you exactly what's going on. Yes, job done. Bang. Thank you very much. That's email, because what will happen is you'll answer a question and it will go back into a queue for this underwriter. So they won't pick up the email and respond straight away. You'll answer it. It'll be in their queue for 2 days, possibly. Then they'll pick it up and go, I've got a question. So it'll come back to us. We'll then answer it. We'll go back in the queue for 2 days. So it could be 4 days before you get to anywhere. And you can imagine when this goes on and on and on, how these things can just drag and drag. So always, why or what is it that they're trying to satisfy themselves about? And if we can't answer it in one sentence or with one document, then how else can we get around answering that question? That often gets you to the resolution, because ultimately they just want off their desk as well. They want to move on to the next case. They just want to sign this off, get comfortable, move on to the next case, and so on and so forth. It's in everyone's best interest. So you just have a conversation about it.
Yeah, absolutely. Absolutely. And like you said, just the point being is, if we've got as many documents on hand as possible, when those queries come back, we can fire them across. But it's the delays are caused when information is incomplete, or we need to get a piece of evidence which isn't readily available, and then that involves third parties, and that's where the delays really kick in then. But there's no need to panic. It's just, let's work diligently. Let's get the information as quickly as we can, and let's get on with it. And then we talk about timelines. So that would be the next step in the process. And this is something that will vary massively from case to case, from client to client, from lender to lender, and from property type and strategy as well across the different options. But we're just looking at an investment purchase application. What would you expect the usual timeframes? And this is, people ask us all the time, how long is this going to take? Well, how long is it going to take? How long is it going to take us for us to submit the application? How long is it going to take us to get the application to offer? How long is it going to take us to get from application offer to completion? Or are you talking from today? How long are we talking until you get the keys in your hand? So it varies on where you are in the process, and actually just be a bit more detailed about the question. So probably a good time to cover that off.
Yeah, so kind of have a stock answer, I guess, because you have to have an answer, and you can't just keep saying it depends, because people do want guidance. As a guide on a purchase, you're looking at roughly 12 weeks. I would say it is a fair guidance for you. The way I look at it is if we've got all of the information on my desk that we require as of today, we'll get that application submitted within 48 hours, typically. If we're good to go straight with evaluation, we can get the evaluation instructed usually at the same time as submission, pay the fees, etc. We'll get that done. So there's 2 days. It'll sit for underwriting for 3-4 days sometimes quicker than that. The bit that people forget is the valuation then goes to the valuer. The valuer then's got to fit that into their diary, which could be 10 days. We've seen it 2 weeks taken for the valuer to have the time to come out and actually inspect the property. Depending on the type of valuation, it could take another 10 days to get the valuation report back. So there's a month gone before we can actually have so we can still work in the underwriting in the background, tick off all those boxes with the valuation report to come back. So we're looking at a month potentially. Once the offer comes out, which is usually about a week after the valuation report comes in, it gets checked, signed off. And this is all assuming there's no issues. Then the legals will get instructed. And that's the bit then, and this isn't a dig at solicitors, this is the bit that we have no line of sight of, because we just do not know if there are any issues on the title, the property, etc. Once they start looking into the legal side of things, who knows? But assuming there's no issues, that again is probably a 6-week process by the time they get the searches back, answers on queries, assuming the vendor solicitor is responsive as well, because sometimes the seller solicitor just disappears. And everybody jumps up and down, but it's like they're just not in a rush themselves. So, as I say, 12 weeks, but there's a lot of things that can influence that timescale.
Well, the first question I'll always fire back whenever anyone asks me, how long is this going to take? The first question always for me is there a chain? Because if this is a property that's in a chain, then we are literally putting our finger in the air and hoping for an answer, because it just depends. There's so many factors around how the other people in the chain are financing, how many people are in the chain, and various things. So I just answer with it, like you said, and isolated. If there's no chain and it's just me buying from you, then there's no reason with everyone working together why we can't get this done in 12 weeks. Perfect. When you start bringing in more units and more parties, it just delays everything. So yeah, hopefully that helps kind of figure that out. Obviously, things that can go wrong, it could be declined by that lender, and then you'd have to maybe then go away and start again, then source a new lender because of a quirk that you mentioned. Again, it might be a down valuation, which means the deal doesn't work. We need to go to another lender. Lots of different things that could happen. But then so there's lots of, you almost starting the clock again then, aren't you? So these are all things that impact. So just to recap, how busy the lender is. If the lender's got really good rate, that means loads of business has piled through their doors. They've got a tranche of funds that they need to get rid of. So they drop the rate, pile in a load of business, and then close the doors. But inevitably that leads to delays with the lender then, because they've got more work that they can physically cope with to deliver. So that puts us, and that happens from time to time with lenders and underwriters, and that just causes headaches for everybody. You mentioned valuer availability, missing documentation, complex portfolios and structures and various things like that. So we can control the speed as much as we possibly can, but there will be outside influences that mean that we can't control it. So move on to step 8 then. So what can go wrong at this stage? What are the common things that applications in, valuations been done, underwriting's been done? What are the key things that kind of can stop a deal getting from this point to offer?
Yeah, I mean, we've covered most of them already, to be fair, in the conversation so far at the key stages, because these won't all happen at the end. These may happen during the process. So we refer to the valuation not meeting expectation in that regard. The rental income not supporting the affordability per the application, that can also reduce, somebody may not have the difference to make that up on that basis, or actually that information. And again, some people get despondent at the fact that the value was less than perhaps the purchase price, or the rental income was lower. if you look at it as this is my protection, so I'm actually, theoretically, I was overpaying for the property, not, and then that's your tool to go back and renegotiate with. So just take the positive out of it rather than try and constantly battle the valuer. That's usually a battle you tend not to win. And a lot of time and energy gets burnt on that. So just bear that in mind. Credit issues, we've covered that. That would have been, you would have thought, highlighted during the application process because of the credit searches. The deposit we would have covered off by this juncture. The only real reason that deals, in my view, outside of the legal process do not complete is because somebody hasn't disclosed something at the front end. So sometimes, and rightly or wrongly, borrowers will hold back information because they think, oh, that will stop me getting a loan or what have you, and hold it back. And invariably it will come out in the process. But invariably it will come out in the process once you've already spent £1,500 on the process. So you're better off getting it out there now. So for example, I paused on the deposit not acceptable when the solicitor comes to pull in the evidence and the money's coming from a different source and you've changed where the money's coming from because that's no longer the case. That lender might not accept a loan from a director's loan from another company, whereas you originally told them it's coming from savings. Those are things that can break the deal at that stage, at that juncture. So we just need to be careful. So as I say, legal stuff we're not in control of, and then there may be something that's terminal in that process so that it can't complete. But the only other reason I've ever really come across the terminal issues are just it hasn't been disclosed at the front end and it's material enough that it breaks the deal. It doesn't mean that we can't do it. It just means we've got to use a different lender because that lender won't accept that rationale. So those are the only bits really that I can see that it goes wrong.
Yeah. And like you said, I think we covered all the other points that we noted prior to that. So great. Let's move on to step 8 then. So, and there's some really good pointers I believe we pulled together here on how to keep this stage smooth, getting through to offer. What's some practical tips or advice you've got to help get the deal over the line then?
Off the back of what I just said, so just tell us everything or just be upfront about everything. No matter, if you think it's material, just disclose it. As I say, it will come out in the process. It always does. And you're better off playing with a straight bat than hope that somebody's not going to find out because that can just cause all sorts of issues. On the back of it, with the documentation that you requested, if the lender asks for 6 months bank statements, don't give them 4. You'd be surprised how much of that stuff happens. So give them the 6 months because they're just going to ask for the other 2. And as I say, because we go into queues and stuff, then that could be a week burnt just because you didn't send the others in on that front, on that as well. So, and the other one is, what will happen on credit checks? You'll get a credit check to the front end, but you will have another credit check just before drawdown. Please keep your credit clean in that process because if you default on a payment in between your offer and drawdown, that may mean that lender can't proceed because of that one default. So that's another reason there. So keep that as clean as you possibly can.
Yeah, just on that point, I've had an instance in the past where someone's a genuine story in between the point of application and completion has gone and bought a motorhome for 70 grand on credit. And obviously, whenever you take out credit, one, so it's impacted affordability, but 2, generally when you take out credit, the other story I've had is someone's taken out a credit card because they think it improves their credit rating to try and build it up, which is true after 6 months. So in the first 6 months of taking out a new credit, your credit actually goes down before it goes up to over where you were before. And so there's this curve you go through, and that slight decrease in your credit report can actually fail the credit score, which can mean declining you. Now, taking out a 70 grand motorhome doesn't happen that often, but it happens. But that impacts then your affordability because there's a big fat payment that goes along with that. And that was a genuine case that we'd had. So this does happen. And so just, if you are thinking of needing to change your car, that sometimes people say, I need to change my car, this, that, and the other. Just have a conversation first before you go and do it and just sense check it.
And this isn't unique to new investors. I had a case where a very experienced investor, significant portfolio, we were in the process of refinancing quite a complicated deal, which I think was about 750,000 all in. We'd been months working on this. We were about to draw down. They did that check. The business partner had emigrated to Australia, and as a result, there was a parking ticket which he wasn't aware of, and that resulted in a CCJ. And I think that escalated to like 800 quid's worth of fines, whatever. It was proven to be wrong, but they would not draw that loan down because that CCJ. And the other issue was we couldn't just settle it. We had to have it completely wiped as an error. And they had to annotate that as such in order for us to complete after months, and I mean months, of trying to put a deal together. And we were literally the day of completion, and that set it back another 2 months.
Yeah.
Trying to get that sorted. So it does happen.
The other one I think of, people are quite quick, and this isn't us having to go at clients, this is just the general feedback of sometimes, and most people are pretty prudent with responses, but just responding quickly to queries. And one of my pet hates is someone will request, for instance, I don't know, a bank statement, and we wait for 3 weeks for the client to produce the bank statement. And then within an hour of producing the bank statement, they're saying, right, is there any update? It's like, well, you've only just given us the bank statement, which we've been waiting for 3 weeks for. No, there isn't an update. You know, there's a process. We've got to upload, we've got to go through it, we've got to check it, then we've got to upload it, then they've got to have time to assess it and then look at the rest of the information and underwrite it and whatever. So there's still plenty of things that need to happen before that. But that always one that tickles me a little bit.
Yeah, no, exactly. It's it's one you like to push back on, but unfortunately, it's just and like, joking aside, people are keen, aren't they? You know, life gets in the way. We know why people don't respond as quick as they perhaps could or should. Life gets in the way, and then as soon as it's off your checklist item, isn't it? It's like, right, where are we then? Come on, hurry up. You know, so it does happen.
Cool. So I think that's what, you know, people can do to just focus on to keep things moving swiftly. And then final section then is around when the offer is issued, and then just sense checking and getting clarity on, you know, the mortgage offer is, you know, formal written confirmation that the lender is prepared to lend. The valuation's been done, the underwriting's been done. And again, this is probably a point that people go, yes, you know, and it is a celebratory point because the mortgage offer is a big part, and it's probably one of the biggest parts of it. The only things but there are still things that can go wrong, right? So the legal aspect only really kicks in from the point the mortgage offer is issued. And so the legal issues then become potentially a problem. Plus chains can fall down and circumstances can change. But the mortgage offer is a pivotal moment in the journey, isn't it?
Yeah, definitely. And what often happens is people get their offer, they check the interest rate on the loan amount, and then they never look at it again type thing. There's a page in there called special conditions. Please read the special conditions, because there will be things in there that are special conditions. So you have to fulfill those obligations in order to complete the mortgage. So, for example, if this is a HMO mortgage that is in a HMO, doesn't have a HMO license, okay, because you're buying it and you're gonna use it as a HMO, the lender's condition is the application has to be submitted before completion, and then obviously it will happen, and so on and so forth. Well, that needs to actually happen before they can complete the mortgage. So you have to follow that. They may have acknowledged something in the valuation report that says a damp and timber report, let's say, will need to be submitted, but because of the timescales, we're prepared to let that happen post-completion. So within a month after completion, we need that back. That will be in the special. So just make sure that you read them, because I've seen them kill deals as well, where people haven't stuck to the conditions or just have not read them. And then as a result, we can't satisfy them. And if we can't satisfy them, we either have to go back to the underwriter to try and get them removed. And invariably, they're in there for a very good reason, and the chances of getting them removed are slim to none. We can usually move them around, as in before the offer, after the offer, possibly after completion. But you rarely get them to come off them altogether.
Yeah. So yeah, really good point. Super important to read, like you said, the headline figures, the purchase price, check the name, your address is name and address spelled correctly, the property address is correct, check the solicitors are noted on there correctly, check all the rate is as stated, because sometimes you may have, at the point of application, you've obviously agreed a price, valuation was carried out, you may have renegotiated the price, but the offer might have been approved on the original purchase. And so if those don't get matched up, then that can cause a problem at completion. Also, sometimes if it's a new build, sometimes at the point of application, there's no address. It might be a plot number that hasn't been identified at the point of application. So that just need to make sure that the address is signaled properly on there. So there's little things that just need to be, that can cause headaches right on and invariably they don't get picked up until the day or a couple of days before completion, which is when everyone gets stressed, right? So yeah.
Also, one other one there is just check when it's due to expire, because these offers do expire. They're not open-ended, and that all lenders will have different timescales. So some of them are as short as 30 days. Some of them are more like 90 days, which is probably more common. 30-day ones that we used to have these when a lot of the rates were changing a lot. They should really shorten their offer timescales. They force people to try and complete quickly so that the rates were being locked in at the right prices and what have you. So yeah, just bear that in mind. Just have a look at the expiry date, make a note in the calendar, because there are things you can do if you're going to go beyond the expiry date. But for all intents, you just really don't want to be doing that because it can incur additional costs with certain lenders as well.
Yeah, absolutely. Okay, well, look, thanks, Mark. Really enjoyed that. I think that's pretty much covered off this stage of the series. And just a quick recap around this process, which is getting to the point where you submit the full application, getting the case allocated to an underwriter, documents being reviewed, valuations instructed, and answering any underwriting queries, rental assessment being done by the underwriters once the valuations come back in and the rental figures and demand have been confirmed, a final underwriting decision, and then getting to the point of the mortgage offer being issued. So that's a nice, smooth run through that process. Hopefully that's kind of highlighted all of the different steps and some of the items that might not be picked up or you might not be aware of. But in the next episode now, we'll walk through what happens between the mortgage offer and actually the completion and the point where you get to have a nice picture with the keys outside the property for your social media page. But ultimately, that stage brings its own risks and responsibilities, right? So it's really important. And I guess just the closing sentiment for this episode is, the period between full application and mortgage offer isn't passive. It isn't, pass the baton over and leave the other side, run with it. There's a lot of passing the baton back and forth. It is a relay, and it's a relay that needs to be managed and worked as a team effectively. And the better you act as a team, making sure that no one drops the baton, that the more chance you've got of coming away with that gold medal of a mortgage offer. So, you like that one?
I like that.
I just thought that one. So, ultimately the lender's stress testing both you and the property. We've said that a number of times. And when you understand a little bit better what's happening behind the scenes, you can work on it, yourself confidently and working with us on it to make sure you get that deal across the line as quick as possible. So hopefully that's been helpful on this stage of the journey. We look forward to seeing you on the next episode. But thanks very much for listening. As always, we'd appreciate it if you could like, share, and subscribe. And if you found this valuable and you know someone that might be interested in buying an investment property, either for the first time or wanting to know more about the process, then please share it with them. Thanks for listening. Thanks for your time, Mark. And we'll see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.